Subscribe to my channel Report Stock.
Imagine a world where our food comes from farms. Well, farms unlike anything you've probably seen before. We're talking about land-based aquaculture. It's this really fascinating intersection of technology and sustainability, a field just brimming with innovation, really aiming to reshape how we source protein. So our mission today is to take a deep dive into aquabounding technologies. They're a real pioneer in this space, and they've just put out their second quarter 2025 financial results, plus an update on a pretty major project. We've gone through their press release, dug into the consolidated financials, the balance sheet, income statement, cash flow, all of it. Our goal here is simple: to pull out the key nuggets of knowledge, the important insights to help you quickly grasp the strategic financial shifts they're making, and what it all means for a company innovating in such a crucial sector. So maybe let's start with AquaBounty's vision. What exactly are they trying to do?
Right. So at its core, AquaBounty is a land-based aquaculture company. They use technology, quite sophisticated tech actually, to boost productivity and sustainability in fish farming.
Okay, land-based, so not in the ocean.
Exactly. They're pioneers in what are called land-based recirculating aquaculture systems, or RAS, think closed containment systems, on land.
So like big tanks.
Essentially, yes, but very advanced. Their design principles are quite specific. They locate farms near consumption markets, cuts down on transport. They're built to prevent disease, which is a huge issue in traditional aquaculture. And critically, they have multiple levels of fish containment.
To protect wild fish.
Precisely, to prevent any escapes and protect wild populations. It's a key part of their sustainability pitch.
Okay, interesting. Now let's get to the numbers. Because when you look at their latest report, Q2 2025, how did they manage such a dramatic financial turnaround? It really jumps out from the report covering the quarter and the 6 months ended June 30, 2025. It looks like a really astonishing shift in performance.
Yeah, it's quite remarkable. And what's fascinating isn't just the scale going from $50.5 million net loss in Q2 2024 down to $3.4 million in Q2 2025.
That's a huge swing.
Huge. But it's the strategic intent behind it that's really telling. This massive reduction, it signals a brutal but probably necessary cut to assets and costs that weren't performing. You see management really prioritizing survival, leaner operations over just expanding at all costs, which, is a critical pivot for a company in a field like this, capital intensive, still pretty nascent.
Okay, so the headline number, the net loss, looks way better. Mainly because maybe they stopped some of the bleeding from past issues.
That's a fair way to put it initially.
Does that mean the actual underlying business is suddenly much healthier? Or is it more about cleaning up the books from past decisions? What does it tell us about their ongoing operational profitability, maybe?
That's a really good distinction to make. A big factor in that improvement was a huge reduction in something called asset impairment charges.
Impairment charges?
Yeah.
Like write-downs?
Exactly. Write-downs. So for Q2 2025, their net loss included a non-cash asset impairment charge of $1.2 million. That was tied to some specific equipment in Ohio. Now, non-cash is the key word here. It's an accounting adjustment on paper. It reflects that they think the value of those assets has dropped, but it's not cash actually going out the door right then.
Okay, so it hits the profit number, but not the bank account immediately.
Right. But compare that $1.2 million this year to the charge they took in Q2 2024. Back then, it was a massive $26.2 million asset impairment charge.
Wow. Okay.
That $26.2 million significantly dragged down last year's net loss. So yes, part of the improvement is cleaning up, but it also shows management being more realistic maybe about what some assets are actually worth now.
So they basically admitted some big investments weren't quite panning out as hoped, wrote them down. Got it. And maybe the clearest sign of this strategic pivot where a lot of these financial threads come together is what's happening with their Ohio farm project.
Exactly. That's central to this story. The report details a really pivotal move. On June 11th, 2025, AquaBounty sold off certain Ohio equipment assets.
Sold them, okay.
Yeah, for net proceeds of about $2.4 million after you take out commissions and fees. And their CFO and interim CEO, David Frank, put it pretty plainly. He said, during the second quarter, we continued to sell available Ohio equipment assets to generate cash for the company.
Right.
This transaction provided us with the liquidity to continue to work with our investment banker to pursue strategic alternatives for our Ohio farm project.
So selling parts to fund the strategy for the whole.
Pretty much. And you see it clearly on the balance sheet, too. The line item, current assets held for sale, it dropped dramatically. It was over $10.8 million at the end of 2024.
And now.
Just $100,000 as of June 30, 2025. So it shows they've pretty much completed selling off the specific assets they'd earmarked. It's a very clear move to get cash in the door.
And when you say improve their cash position, what does that actually mean for their day-to-day liquidity? Getting cash seems like the main theme here.
Oh, absolutely. It had to be. Their cash and cash equivalents, it totaled $730,000 at the end of June 2025.
Okay, $730K.
Yeah.
How does that compare?
Well, it's significantly up from $230,000 at the end of December 2024. So definitely an improvement. And if you look at the cash flow statement for the first 6 months of 2025, you see exactly how they did it. Those proceeds from selling assets, that brought in $4.6 million.
That's the bulk of it, then.
It's a massive driver, yeah. Compare that to the same period in 2024, they only got about $149,000 from asset sales then.
Wow, okay. That change alone really tells a story. Strategic financial maneuvering, like you said.
Definitely. Moving from needing cash to actively generating it from, well, non-core or maybe underperforming assets. Now, we should be clear, for a company with their ambitions, $730,000 in cash, that's still a very, very tight runway.
Right. Doesn't sound like much for building big fish farms.
Exactly. Imagine trying to build a cutting-edge, sustainable farm with just enough cash for maybe the initial groundwork. It really highlights how urgent their ongoing search for more funding must be.
That puts it in perspective. So besides selling assets, were there other big moves impacting their cash flow? Any sign of just tightening the belt operationally?
Yes, definitely signs of that too. The cash flow statement also shows something interesting. $2.0 million in loan forgiveness for the first half of 2025.
Loan forgiveness. Someone just wrote off their debt.
It appears so, or at least part of it. That positively impacted their cash from operations. And overall, the cash they used in operating activities dropped significantly. It went from $8.7 million burned in the first half of 2024 down to $3.9 million burned in the first half of 2025. That points strongly towards tighter management of day-to-day spending.
That's less than half the burn rate.
Right. And if you look deeper into the statements of operations, you see very deliberate cost-cutting. Sales and marketing expenses, 0 for the quarter. 0. Same for research and development expenses. Compare that to Q2 2024, they had costs in both those areas.
So they've paused R&D and sales efforts.
Seems like it, or drastically scaled them back for now. And general and administrative expenses, G&A, also saw a big cut, down from $3.1 million to $1.7 million for the quarter. So yeah, it really suggests a very focused effort to streamline and just reduce the rate they're spending cash.
Okay, so asset sales, loan forgiveness, and serious operational cost cutting. It sounds like they're pulling multiple levers. And you mentioned something about liabilities, too, something on the cash flow statement.
Ah, yes. That was quite an interesting financial maneuver. In the supplemental disclosures on the cash flow statement, there's a note about a non-cash conversion of accounts payable to current debt.
Okay, translate that for us.
So, think of it this way. Accounts payable are basically the company's immediate bills, money owed to suppliers, things like that, demanding cash soon. What they seem to have done is renegotiate over $7.3 million of these immediate bills into current debt, essentially turning short-term IOUs into a slightly more structured, maybe slightly longer-term loan.
It's not new cash coming in, but less cash needing to go out right away.
Exactly. It doesn't magically create cash, but it frees up immediate liquidity. It gives them crucial breathing room by pushing those obligations down the road a bit into a more manageable payment plan. It's a classic move to, well, buy some time.
Makes sense. Okay, so after looking at all this recent performance, the cost cuts, the asset sales,
Yeah.
what does the company actually say about the road ahead? David Frank's comment you mentioned earlier about keeping stakeholders apprised on the Ohio project's strategic alternatives sounds like that's still very much up in the air.
It does, and that naturally leads to looking at the risks and uncertainties they themselves identify. The forward-looking statement section in their release is always revealing.
What are the big ones they flag?
Well, first, they acknowledge their history of net losses and state they expect future net losses are likely. That's pretty standard for companies in their stage, but important. Crucially, they talk about their ability to continue as a going concern.
Ah, the going concern language. That's always a flag, isn't it? Finance speak for, can we actually stay in business?
It is. It indicates substantial doubt, or at least a need to address potential issues staying afloat. They link this directly to their ability to raise more money, possibly through more asset sales. They also specifically mention challenges in securing financing for the Ohio Farm project itself, maybe through things like municipal bonds. And they note that kind of financing could come with restrictive covenants.
Meaning strings attached.
Exactly. Conditions or limitations imposed by the lenders that could restrict how they operate, what they can spend money on, things like that.
So getting the money is one hurdle, but the terms of that money are another. What about the operational side, actually farming these fish?
They flag operational risks too. Things like potential disease outbreaks, always a risk in aquaculture, even land-based. And the challenge of just efficiently and cost-effectively producing salmon at the large commercial scale they envision. Scaling up is often harder than it looks.
Mm-hmm. Any other risks?
Yeah, they mention the usual suspects too, potential security breaches, the risk of needing further write-downs on assets, and just broader economic disruptions that could impact them. And finally, they're very explicit. They don't expect to pay any cash dividends in the foreseeable future.
Which makes sense. They need every penny for survival and growth.
Absolutely. It underlines their focus is entirely on reinvesting back into the business right now. Taken together, it paints a clear picture of the significant hurdles they still face, even after these recent maneuvers.
Okay, so let's try and wrap this up. To recap, we've seen AquaBounty navigate a really tough period. They've made some pretty significant strategic financial pivots, mainly by selling off assets tied to that big Ohio project to get cash, improve liquidity, and that's dramatically reduced their reported net loss. It really is a compelling example, isn't it? A company making some hard choices financially to try and stabilize itself in what's still a very new, high-potential industry.
Absolutely. It's survival mode, but strategically executed.
And hopefully this deep dive shows you, our listeners, how a company like this, pioneering, innovative, but also really capital-intensive, has to constantly adapt its financial strategy just to keep pursuing its mission. Understanding these kinds of reports, the members, the statements, it gives you a powerful lens. You're not just seeing financial health, but you're seeing strategic direction, the real-world challenges of bringing new tech like this to market.
It's the story behind the numbers.
Exactly. So that brings us to our final thought, something for you to chew on. Given AquaBounty's clear need for more funding and all those risks inherent in pioneering these new aquaculture methods, what alternative, maybe more innovative financing structures or partnerships could actually secure their long-term future? What might it take to truly scale their vision of sustainable land-based fish farming? It's a really fascinating question, I think, for the future of how we produce our food.
Subscribe to my channel Report Stock.